Abdul Ghani. Today, our group will present about Aurora Textile Company. Aurora Textile Company operates since 1883 in Aurora, United States. Aurora Textile Company has historically been one of the premier textile company in the United States, and now they have a decision to make. With the opportunity to invest in equipment that could help cure their slumping financial. For this case, we must carefully explore whether the investment is appropriate for a company with such an uncertain future. With that in mind, they believe that the Zinzer 351 is the perfect investment to pull the company out of this slump. As a company that has been able to deliver a premium product for the consumer, the Zinzer 351 will allow the company to continue to do that while also begin relieving some of the financial stress that they have been under. So in our analysis, that Zinzer 351 project will yield a net present value of about $6,474,082 and will discount payback period of 5 to 6 years. This project not only bring a big enough payoff of demonstrated by the NPV, but also fit their timeline. The discounted payback period indicates that our investment will be realized before the company is not able to recover from their current financial struggle. The Zinzer 351 is a project that this company must undertake if they want to begin to bring value back to the shareholder who have become more and more impatient with them in recent time. This is an opportunity for Aurora to turn around its fortune and once again prove that it is a premier textile company in the United States especially. When decide whether the Zinzer is a worthwhile investment or not, they will analyze that the decision like there were any other investment decision. Finding the net present value of the project will ensure that the project will have large enough cash flow to clear out 10% hurdle rate. When calculating the NPV of the project, we discover that investing in the Zinzer will yield a positive of NPV around $6,350,023. Okay, for the next topic, I will give my group members to present.
Body of the report. This is partly due to the fact that many of the firm's current assets are largely debtor of account and inventory. While it is true that companies, competitors, and industry continue to lose money with effective cost control strategy, such as strategies that increase profit margins, reduce operating costs, and manage inventory and account receipts accurately, it will be crucial for Aurora to stay afloat. In our analysis, we calculate inventory by dividing cost of goods sales by the number of days in a year, and then multiplying by the numbers of days of inventory held, 13 days in the status quo scenarios. The current equipment will be depreciated using the straight line method with zero salvage value. The current books value of the machine is $800,000 and the depreciation expenses is $200,000 for the next 4 years. Using these assumptions, keeping all else constant in a 10 years horizon, the MPV of the Hunter plants is about 8.1 million. New project invest in Zinsser machine. Aurora Textile Company also has been option of investing in the new Zinsser machine for the Hunter plant. The main difference between investing in the Zinsser plant and maintaining the status quo in an initial investment of 8.25 billion and the receipt of 908,000 in the after-tax sales proceed from selling the existing machine. Additionally, there is the initial $50,000, which is 32,000 after tax cost for training employees, but this cost is only incurred once. In their first year using the Zinsser machine, there will be 5% decrease in the sales volume, but selling price will be increased 10%. Material cost per pound will be the same as the status quo, but conversion cost will be decreased to 0.4077 dollar per pound per year due to lower power, maintenance and return costs. Days of inventory held will also drop to about 20 days. All other assumptions are the same as the status quo. In this scenario, the MPV of the Hunter plant is about 15.87 million if Aurora invests in the new Zinsser machine incremental cash flow, the net effect of the new project. When looking at the incremental cash flow for the new project, replacing the old machine with the Zinsser machine is a good investment. The MPV of the investment is $6.33 million. The IRR is 28%, much higher than the 10% hurdle rate. While all the assumptions made could affect the MPV of the project, the major concern that could erode the value of the project is whether Aurora can survive for 10 years. In our yearly termination analysis, if we ignore the salvage value, the time horizon break-even point of incremental MPV is between 4 and 5 years, about 4 years. However, even if Aurora shutdowns the earlier they terminate, the higher the salvage value of the Zinsser machine will be. Therefore, the time period of the break-even might be less than 4 years. If the Zinsser machine can be sold for its 50% book value at early termination, it only needs 2 years for the project to add value to the Aurora Textile Company. For our sensitivity analysis, the main things we focus on were for production level and price. Here is a chart representing the IR for certain production level and price. Our production level estimates were based on the fact that we don't know how the market will react with increased foreign competition. The textile growth rate we use for our most likely model is the domestic rate of growth, not the world growth rate. We don't know if letting foreign competitors into the market would significantly shift the industry out of America, or if it will keep a constant growth at 2%. Our price estimates were based on the new WTO mandate that is going into effect in 2005. With the tariff and quota on the textile industry being lifted, there will be a significant growth in the amount of textile goods imported into America. Even though the cost may be high to transport those goods into the States. Specifically, would it be better to invest in the Zinsser or to pay a dividend to the shareholder. Be sure to explain the primary reason that justify your recommended course of action. The U.S. textile industry is going through a tumultuous time, and most companies are experiencing losses. Therefore, it would seem like an old time to invest more money into the company. However, as the industry evolves, Aurora Textile Company need to innovate to stay competitive. The industry is moving toward demand for a higher quality product, and Aurora cannot afford to fall behind. The Zinsser machine will help Aurora meet his demand. If the project were accepted, the Zinsser machine would replace the current machine in the Hunter plant. Because the other three Aurora plants will not be affected by this decision, we compare the cash flow of the only the Hunter plant with new machine and without. The NPV of the Hunter plant is about $15.86 million. If Aurora invests in the Zinsser machine, only $8.91 million without investment. In addition, when looking at the incremental cash flow of the investment, the NPV is $8.6 million and the IRR is 28%, much higher than the 10% hurdle rate. Taking all of this into consideration, Aurora should invest in the project. In addition, accepting this project falling spot price for cotton could be beneficial to Aurora Textile Company in the future. However, the company also need to implement other strategies to improve the profit margins, including reducing operating costs and appropriately managing inventory and account receivable. This change will help Aurora move in the right direction to ensure that they are not forced to shut down operation in the foreseeable future.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Shukri Ahmad. I want to present about result and finding of Aurora Textile. We prepare to provide financial ratio that present a clear picture of Aurora financial condition. From 1999 through 2002, the financial performance of Aurora was unattractive and disheartening. This could be attributed to the business risk that arose from the intensive competition that characterized the industry in which Aurora operates. Absent an industry benchmark or comparable with which to guide the performance of Aurora, we utilize a trend analysis of the period 1999 to 2002, which 1999 as a reference point. We noticed that all measures of profitability have won. On a cumulative annual basis, net sales have been declined by 50%, while profit margin of ROA were always in the negative. While raw material cost has a percentage of net sales have been declined, the cost of conversion is escalating and affecting the bottom line. It is obvious that Aurora needs to manage the expenses to generate profit from sale, while of the surface the liquidity measures have improved. It is doubtful that the company has the ability to meet its current obligation with just cash and cash equivalent.
Selamat sejahtera, Madam. My name is Anwar bin Zakaria. My student ID 201701040074. After hearing the explanation from my friend, it can be concluded that Aurora Textile has performed poorly over the last 4 years. This is evident from the fact that in the year 2000, the company was forced to close 4 manufacturing facilities. It was performed as a measure to minimize the manufacturing expenses and feed the textile company in the textile market that was becoming small. Reviewing the consolidated income statement for the year ended December 30, 1999 until 2002, it is clear that the company net sales reduced from $245,908 in 1999 to $147,503 in 2002. The same is true for raw material costs, the cost of conversion, and gross margin. The operating profit in 2002 was $445, which is relatively low compared to $6,234 in 2001 and $4,109 in 2000. The company's sales are affected by stiff competition for cheap imported yarn from Asia industries that flooded the US market. In addition, the profit margin are affected by the liability related to customer return. The customer return saw the textile company lose between 5 to 7.5 times more on revenue in reimbursement. In order for Aurora Textile Company to survive in the competitive market, there is a need to modernize their operation and cut costs. The proposal by to invest in a new machine Zinser 341 will improve the company performance and help to reduce the production expenses. The machine will reduce maintenance and power cost amounting to $0.03 and customer return equal to 0.077 based on conversion cost for 2002. The purchase of Zinser 341 reduced the rate of customer return that is critical during the period the WTO lifted the ban of quota in January 2005. When the company makes more money, that is will attract more investment by the shareholder that will help Aurora Textile industry to operate and survive in the competitive market. Thank you.
Assalamualaikum and good morning. My name is Safri bin Muhammad Arshad. Today I will present about future research of Aurora Textile Company. For the future research, we will suggest about how sensitive is the economic life of the Zinser investment to its value to investor. In other words, if the company survive the entry 10 years, what is the NPV of the project? What if the company can survive only 4 years? What is the NPV of the project? For our sensitivity analysis, the main things we focus on were production levels and price. Next is the incremental cash flow, the net effect of the new project when looking at the incremental cash flow for the new project. Replacing the old machine with the Zinser machine is a good investment. Lastly is, what are the relevant cash flow for the Zinser investment? Using a 10% WACC and assuming a 36% tax rate, what do we get as the NPV for the project? What are the value drivers in your analysis? What do you estimate as the cost per pound for customer returns under the Zinser alternative?